Good morning, everyone. I'm Tim Mischling, Research Associate with the Citizens Research Council of Michigan. I'd like to welcome you to today's webinar, Offering Perspectives on Michigan's Personal Income Tax. Just as some attention in Washington, D.C. has been directed at the idea of tax reform, in part offering tax relief to payers of personal income taxes, so too our legislators in Lansing have spent part of their time in session this year discussing ideas to cut the rate of the state personal income tax or completely eliminate the tax. One of the guiding principles for the Citizens Research Council is the idea that better information leads to better government. Policymakers, be they elected officials for the state or local governments, or the people electing those officials, need information to draw upon when making policy decisions that affect the collection of our tax dollars that pay for government, or decisions on how those tax dollars should be spent. It is that principle that led to the research and publication of a new report that we will discuss today. The Citizens Research Council of Michigan is a statewide, nonpartisan public affairs research group. This is the Research Council's 100th year of operation. On longevity, we attribute to our promotion of sound public policy for state and local governments through accurate, independent, and objective research. We are a private, not-for-profit entity, and we rely on the charitable contributions of foundations, businesses, and corporations. I'd like to encourage all of you to join our circle of supporters and help us to continue to provide high-quality, independent information on important policy topics in Michigan. You can learn more about the Research Council at www.crcmich.org. At the right of our website, you'll find an opportunity to sign up for our email distribution list so that you can be notified about newly released papers and reports. Our presenters today are Eric Lufer and Jordan Newton. Eric is president of the Citizens Research Council of Michigan. He has 30 years of experience with the Research Council, with most of that time having been spent working with local governments. He has worked on city charter issues, state revenue sharing, property taxes, intergovernmental collaboration, consolidation of local governments, and many other aspects of local government. Jordan is a recently graduated student from the Michigan Masters of Public Policy program at Michigan State University. He has a BA in economics from Gonzaga University. He is starting research with the Citizens Research Council, focusing on state affairs. Please note, we are recording this webinar and we will post it up on our webpage where it will be available for you for future viewing. Second, we have everyone but the presenters on mute, so we will not be able to hear you if you speak. To ask a question, please type the question into the questions pane that should appear on your screen. You can type these questions at any time. If you have any technical problems during the webinar, please let us know by calling 734-542-8001. After the webinar, you will receive an email soliciting your feedback. We would very much appreciate hearing from you. With that, I'll turn things over to Eric.
Thank you, Tim, and thank you all for coming, or virtually coming, to attend today's webinar. Our plan today is to do a bit of a tag team. I will talk to you about some previous tax cut efforts, and we'll look at the amount of tax revenues the state is bringing in, and I'll provide some interstate comparisons to better understand how our taxation of personal income compares with other states. Then I'll hand it off to Jordan to discuss the role our state personal income tax plays in funding state government and what would happen if state income tax rates were cut or the tax was eliminated. They say that those that don't learn from history are doomed to repeat it. Let's take a look at the history of some of the income tax rate changes in efforts to phase down the income tax rate over time. Michigan has what I call a love-hate relationship with the personal income tax. It has been the tax that policymakers have focused on cutting the rate for most frequently, but it is also the tax that they have gone to raise the rate when times are tough and the revenues flowing into state government are lean. Michigan was one of the last states, many states went before it in implementing a state income tax. Michigan's income tax was introduced in 1967 at a rate of 2.6%. Delegates at the 1961 Constitutional Convention spent an inordinate amount of time discussing a tax that was not yet levied at the state level. At that time, we had a local income tax. Detroit, Highland Park, and Hamtramck had all begun to levy the income tax, but it was not levied at the state tax. Still, the CON delegates focused on it for a lot of discussion. And the primary outcome of that was a constitutional prohibition in the 1963 Constitution that income taxes should not be levied that are graduated as to rate or base. So the tax was introduced at a flat rate of 2.6% in 1967, and it has stayed a flat tax ever since. You can see from the chart that the tax has not remained at the same rate for very long in our history since 1967. Within 4 years of the enactment of the tax, the rate was raised to 3.9%, and then another 4 years down the road, it was raised again to 4.6%. We hit the early 1980s when Michigan's economy went sour, and the rate was increased all the way up to 6.35%. There was a lot of political backlash at the time when that rate was increased such a high amount. Ultimately, that led to the recall of 2 state senators. The tax was returned to 4.6%, and then a few years down the road reduced to 4.4% in the early 1990s. I'll discuss what happened since that time in a moment. First, I want to focus on the second line that I've put for a few years on this chart. The shaded gray line you can see down here. The Michigan Department of Treasury has an office called the Office of Revenue and Tax Analysis. They've gone through for this period of time and calculated the effective tax rate. So while the statutory tax rate has been levied within the 4-point-something% for much of the history, in effect, people are taking credits, deductions, using exemptions to reduce their overall tax burden. And the Office of Revenue Tax and Tax Analysis was figuring out what the final burden is. And you can see there that the effective tax rate has been running, or for that period of time, ran about 2 percentage points less than the statutory tax rate. So there are 2 periods in history that I want to focus on, again, going back to the idea that those that don't learn from history are doomed to repeat it. First was a period in 1999 when the state set out to reduce the state income tax rate. The tax had been levied at 4.4%, and the Governor Engler and those in the legislature acted to reduce the tax rate, hoping to get it down to 3.9%. Public Acts 2 through 6 from 1990 set up the path so that the tax would reduce by 0.1 percentage point per year for 5 years. Going into that period of time, the economy had been strong and the state revenues were, the state budget was flush. Good times were reflected within the state revenues and state taxes. When the events of 9/11 occurred in 2001, economic activity slowed nationally, and Michigan was beginning what we now know was a single state recession. So state policymakers had a choice at that time of halting the automatic tax rate reductions until the economy recovered, but they chose not to. Even as the state economy was contracting and state economic activity was slowing, which would lead to slower, less tax revenues from a number of sources, the tax rate reductions for the income tax were allowed to occur. In retrospect, these tax rate reductions contributed to the state's structural budget deficit and worsened the ability of the state to deal with the conditions that led to the worsening through Michigan's single state recession. This is admittedly a bit of Monday morning quarterbacking, but we know in retrospect what happened and how the continued tax rate reductions contributed to the worsening situations. So we need to keep that in mind as we think about any future tax rate reductions and any efforts to put the state tax rate on autopilot for reductions. The other event I want to draw your attention to happened at about the same time and happened in the city of Detroit. Throughout the 1980s and 1990s, the city of Detroit had among the highest property tax rates in the state. It had the highest local option income tax rate, and it was the only city in the state to levy a utility users excise tax and a casino gaming tax at the local level. The tax burden was seen as an impediment to regrowth of the city. Governor Engler, working with city leadership, set out to scale down the income tax rate. Like they did for the state tax, an effort was put in place to scale down the tax rate by 1/10 of a percentage point over 10 years. The net result of that would be that the tax on residents would go from 3% down to 2% when this process was finished. And for non-residents, the tax would go from 2% down to 1% over that 10-year period. The quid pro quo for this was an effort also going on at this time that the changes in statutory state revenue sharing that were going to affect how the money was distributed among the cities, villages, and townships in the state would include special provisions that kept the city of Detroit whole. So while other cities or townships might gain or lose because of the change in the formula, Detroit was going to receive a steady amount going forward. Knowing that Detroit's financial situation was precarious even then, there was sort of a circuit breaker put in place for these automatic tax rate reductions. You can see them on the screen here. Those provisions said that if more than one of these conditions occurred throughout this period, that the tax rate reductions would freeze at that rate. And then once the conditions cleared up, then the tax rate reductions would go back into place. So you can see on the screen that those provisions included 2 years of withdrawals from the city's rainy day fund or exhaustion of that fund completely. Year-to-year decline in the income tax revenues when adjusting for inflation of more than 5%. Changes in the unemployment rate that took it over 10%. Or changes in the amount of property tax revenues, the property tax base, when comparing that to the state total. So what did occur, in fact, we got to about 5 years into the process, and these conditions, more than one of these conditions occurred, and the tax rate was frozen at 2.4%. It stayed at that rate for several years until the state, working with the city of Detroit, enacted a package of bills to try to get the city with sufficient money to fix the streetlight system in the city. So part of that package of bills was to hold the city's income tax rate at the present 2.4%. And then other taxes were adjusted and some earmarking went on so that the city had revenues to fund street lighting and do a number of other things that the city has been doing post-bankruptcy. One other item from the past that will affect the future that is worth mentioning. Late in 2015, on the heels of the May rejection of the highway funding package, the state policymakers regrouped and settled on a package of bills that were to get more money for road repair, and that there were other things related to that. One of those was a provision that you see before you, Public Act 180 of 2015, that set in process in year 2023 and thereafter a formula that measured growth in the total general fund, general purpose tax revenues, and looked at whether those revenues exceeded 1.425 times the rate of inflation over the same period of time being measured. Now, the important things to think about in this, the provisions only allow for a tax rate reduction. They do not allow for tax rate increases. We know that with Michigan's budget or economic cycles, the ebbs and flows, that Michigan has good times and bad times. So there will be periods of time when general fund, general purpose tax revenues grow, and there will be times when it is contracting. And while this tax provision allows for the tax rate reductions during the good times, it does not allow increases during the bad times. So it's not setting it on an even plane to try to keep it at a certain percent of economic activity going forward. It will ratchet it down from time to time and affect future revenues from that point forward. It is also worth noting that the tax rate reductions will come out of the general fund, general purpose budget. They are not to affect the school aid fund revenues that also depend on income tax revenues. So the question, whether we're thinking about an income tax rate cut now or in the future, is how Michigan's tax system, are the revenues adequate to allow for such a cut? The word adequate is a subjective term, and what it means to different people will vary. So what I propose is to look at it in a number of different ways. First, we will look at the tax against itself. How is the tax grown over time? How do current tax revenues compare to past tax revenues? Second, I propose that we look at the tax revenues coming to the state relative to the constitutional revenue limit that was put in place in 1978 by the Headlee Amendment. And finally, I propose that we look at Michigan's tax revenues compared to other states. While the first two might tell us how Michigan's doing, it won't necessarily reflect the competitiveness of the state. So again, this is a subjective measure. I don't propose to tell people how to think subjectively about this, but a few objective measures to measure the adequacy. First, let's look at total tax revenues. You can see with the solid black line that the last few years have had record high levels of tax revenues. They have not been growing on a steady growth plane over that time. What we see is that from 1999 to 2007 or so, there was slow but steady growth of the revenues. And then the Great Recession hit, and state tax revenues in Michigan and a lot of other places took a hit and declined. And since 2011 or so, there has been very slow but steady growth with a lot of very little growth from year to year. So 2011 to 2012, and then 13 to 14, and I would say 15 to 16, you could see again that there has been very little growth over those periods. But looking at the nominal growth of revenue only tells part of the tale. We know that people will get raises in their jobs and and that will affect the amount of revenue the state yields in tax revenues. We also know that inflation affects the ability of consumers to purchase goods. The value of $1 in 1995 is not the same as it is today. So when we account for that with this dashed teal line above it, above the black line, you can see that state tax revenues peaked in the year 2000. They were fairly strong heading into that in the late 1990s. And then, of course, we had the single state recession, and you can see the decline in tax revenues from there. And we hit the Great Recession, the period from 2007 to 2009, and a very steady decline since then. And coming out of that, from 2011 to 2016, tax revenues have been fairly flat over that time. A little bit of growth, a little bit of contraction from year to year, but 2016 is not markedly different than 2011 in terms of the amount of revenue, state tax revenues coming in. We can repeat this exercise specifically for the individual income tax. You can see with the black line that state tax revenues in 2016 were at their highest point throughout the history of the tax. This chart goes all the way back to 1968, the first year the tax was levied. And so tax revenues in 2016 are higher than at any point in the past. But again, the nominal tax revenues only tell part of the tale. And when we look at the teal line above it, the dashed line, you can see that income tax revenues in 2016 are at a level that were last seen in the mid-1990s. Again, 2000 marked the high point for tax revenues coming in from individual taxes. But since that point, individual income tax revenues declined markedly. There has been some bounce back since 2009, but not yet to the peak, and on a scale going back to the mid-1990s. How about as a percent of our, or as a comparison to the constitutional revenue limit we have in Michigan? In 1978, Michigan voters adopted a series of amendments to the Michigan Constitution, commonly referred to as the Headlee Amendment. Among the limitations was a provision that state tax revenues should not exceed the level in place then as a percent of personal income. This was calculated at 9.49% of personal income. You can see that this Michigan tax revenue stayed relatively close to the limit for the next 20 years. Efforts to balance the state budget brought the state to the limit in 1984. And then when you go ahead another decade, the influx of new revenues as part of Proposal A, when the state was collecting more taxes to send to local school districts, again brought the state to the limit. You can see starting in 2001, the beginning of Michigan's single state recession, and you can see the consequence of that single state recession on total revenues coming to the state relative to this limitation. State revenues have declined steadily as a percent of personal income to the point that in 2016, the state was $9.4 billion below the revenue limit. But comparing Michigan to itself over time only tells part of the story. While Michigan might have been high before and is high now, or low compared to other states, without having some ability to benchmark ourselves against others, we don't really understand how we fit into the national or global scene. So to make such a comparison, we look at revenue compiled by the Census Bureau at the federal level. Part of their mission is to help with the Bureau of Economic Analysis and measuring economic activity throughout the nation and understanding what's going on at the state and local level. state and local government activity is not insignificant. Total government employment from state and local governments in Michigan account for 13% of all employment, and that's fairly common, within a few percentage points what's going on nationally. So to make such a comparison, we use two different benchmarks. We want to normalize comparisons because when you're comparing something like Rhode Island to California or Texas, it's not much of a comparison unless you can account for the differences in population between states or account for differences in the ability to pay based on the personal income of the states. So first you can see on the left here the per capita comparisons. If we go back to 1983, you can see that Michigan was in fact a fairly high tax state, ranking 12th in the nation at the time, 13% above the national average. But over time, there's been a number of factors going on. On the per capita side, the state population has not been growing. It's been pretty flat over the last couple decades. All the while, income, as we have just documented, has had its ebbs and flows, but not growing very significantly. And then on the personal income side, comparing our tax revenues to personal income, you can see we ranked 9th in 1983, and since that time, national growth in personal income has outpaced what's been happening in Michigan. So if we fast forward then and look at the 2008, sort of the beginning of the Great Recession, by then Michigan ranked 30th on the per capita amount, 19th as a percent of personal income. And by 2013, we ranked 35th in per capita and 34th as a percent of personal income. And the revenues coming in were 18% below the per capita average nationally, and we were 92.5% of the average as a percent of personal income. This map shows that gives some perspective on how Michigan's taxes compare to other states. And when you look at the states that were immediately above or below us, you would find that we compared to Montana, Louisiana, and Indiana, to New Mexico, Arkansas, and North Carolina in terms of our immediate neighboring states, and sort of on this global or national scale. And when you look at our immediate neighbors, we were comparable to Indiana, but we're bringing in less tax revenue as a percent of personal income compared to Wisconsin, Illinois, Ohio, certainly less than New York or Minnesota. What about for personal income? Again, you can see the same sort of trend going back to the 1990s. We were a fairly high income tax state, ranking 18th or 16th, depending on the measure of normalization. By 2013, our income tax revenues were 34th among all the states, 19% below the national average as a per capita measure, and almost 10% below as a percent of personal income. Again, we can look at sort of the national scene on what's going on, and you can see that our immediate neighboring states, Wisconsin, Illinois, Indiana, Ohio, all are shaded darker than Michigan in this map, denoting the higher amounts of revenue coming into those states from personal income taxes compared to Michigan. Another way of looking at the comparability of Michigan to the other states is to look at the tax rate being levied. This matters a lot for the optics as people think about where they want to live or businesses think about where they want to locate. There are 43 states on this chart. There are 7 states that do not levy an income tax. This chart does include New Hampshire and Tennessee that tax only dividend and investment income. There are 8 states you can see here that levy a flat rate like Michigan. Those include Pennsylvania, Indiana, Illinois, Wisconsin, Colorado, Utah, again, New Hampshire, North Carolina, and Tennessee again. So those states have flat rate taxes, as Michigan, that there is only one tax rate compared regardless of the level of income. The other states have graduated income taxes, meaning as the amount of income earned in a household increases, the tax rate might go up. And these states tend to have brackets that income within certain ranges or have a rate applied, and then the next higher bracket will have a higher rate applied. What I've done in this chart is show only the lowest tax bracket, the rate applied to the lowest tax bracket and the highest tax bracket. I thought showing every bracket would make it a very busy chart and hard to follow. The overall chart shows the rate applied to the highest tax bracket, and you can see that only 5 states are levying a tax rate on the highest tax income in the state at rates lower than Michigan. Most are levying higher tax rates, and when you look at states like Maine, Minnesota, and Oregon, even those people paying at the lowest tax bracket have a rate applied that is higher than is applied to all incomes in Michigan. Part of the comparison of other states is to look at the composition of the tax, and when we think about this, we like to use the analogy of the three-legged stool, that you don't want to be over-reliant on any single revenue source, but be fairly balanced for the overall state and local tax system with revenues from property tax, sales tax, and income taxes. Going back to 1993, just before Proposal A in 1994, with the major tax shifts that occurred then, you can see that Michigan at the time was high on property taxes, low on sales taxes, and about a third of the revenue from income taxes. Coming ahead to 2013, you can see this line here shows Michigan, and that's comparable to the national average. Michigan still is a little bit above average in the amount of revenue coming from property taxes, about average for sales taxes, and just a notch below average for income taxes as a percent of the total. I mentioned before that there are 7 states that do not levy a tax on income, and the takeaway from this is that these states are either, for the most part, these states are either big on tourism or big on mineral extraction. You have states like Florida and Nevada with Disney World and the gaming industry in Nevada, where they get a large amount of revenues, and by leaning heavily on the sales tax, they are able to export their tax burden to visitors to those states. You have states like Texas, Alaska, and Wyoming that are very big on the mineral extraction, whether that's coal or oil or what have you. So they are able to benefit from the revenues generated from those mineral extraction. And then there's some states that just stand out. Washington has an economy very comparable to Michigan. Washington with computers and airplanes, Michigan with automobiles and other forms of manufacturing. But Washington has made a policy decision to lean very heavily on the sales taxes, and they've made it through. As part of the research for this, I went back and looked at some of these states, and I'm here to tell you that having no income has not been a panacea for them, that they have struggled through hard times by being dependent on mineral extraction. They're subject to the whims of the market, different tourism, ebbs and flows, what have you. So even these states have struggled through sometimes. So with that, let me turn it over to Jordan to give some perspective on how Michigan's individual income tax plays a role in Michigan, and what would happen if we thought about changing that.
Thank you, Eric. Michigan's budget relies heavily on the income tax. In 2015, 1/3 of state tax revenue came from the income tax. Collections were the second largest of any tax base next to the sales and use tax, as you can see in the chart on the left. This does not fully demonstrate the importance that the income tax plays, however, as a significant portion of tax revenue is earmarked before it reaches the state. 76% of the revenue from the income tax goes to the general fund, compared to 9.2% of the sales tax that is unearmarked and goes to the general fund. As such a large portion of the income tax is not earmarked, it is the single largest contributor to the general purpose portion of the general fund. 72% of the GFGP budget is raised through the income tax, compared to 17% from the business tax and another 17% from the sales and use tax. With such a large portion of the general purpose budget coming from the income tax, the legislature would need to address the potential decline in revenue if they were to cut the income tax rate or remove it completely. There are three general ways that they can adjust revenue. First, they could rely on existing revenues if they were expected to grow at a rate sufficient to offset the losses. Second, they could raise tax revenues elsewhere to replace the income tax. Or third, they could cut spending equivalent to the rate of the decline. Each of these options has complications. The Michigan Constitution and state law limit the legislature's flexibility to change and distribute tax revenues, and federal matching requirements mean that in some instances, cuts will require more than a dollar-for-dollar decline in spending. Next, we will look at the feasibility and impact of each of these options. The first option is relying on existing tax revenues. For this option to be feasible, revenues would have to be on a pretty significant upward trajectory. The chart on screen shows revenue from each major tax source indexed for inflation. As the figure shows, revenues from each major source have seen little growth. While the sales, use, and income taxes saw increases in the 90s, each fell off in the early 2000s, and growth rates have been low over the last decade. The tobacco tax saw a few increases in revenue, but those were peaks caused by increased rates. These trends show that there is little reason to expect existing sources to increase revenue sufficiently to offset a decline in the income tax rate or an elimination entirely. And with the state's economy trending towards a larger focus on services rather than goods, the lack of sales tax on services makes it unlikely that other taxes are going to increase in revenue over the next period of time. Beyond the problems with expecting tax revenue to increase, the increase in special purpose and earmarked funds makes it unlikely that current revenue streams will effectively replace losses from an income tax cut. Since 1994, roughly 63% of tax revenue has a legal requirement of what it is used for. While the sales tax and use tax are of the order of magnitude where increases in revenue could start to fill in for an income tax cut, they are both directed towards specific functions, meaning only about 10% of revenue increases would go to the general fund. So even if economic activity were to increase due to the decline in income taxes, only 10 cents of every dollar of revenue would go to the general fund. The combination of trajectory and the heavy earmarking of alternative taxes makes it unlikely that the state could afford an income tax cut without either increasing taxes or cutting spending to offset declines. Another option the state could employ to offset revenue declines would be to increase taxes elsewhere. For state governments, the majority of tax revenue comes from three sources: the income tax, the sales tax, and the property tax. It is unlikely that an increase in taxes outside of these sources would raise enough revenue to offset a decline in the income tax. Thus, for this analysis, we focused on sales and property taxes as potential alternatives to the income tax. When increasing a tax, the state has the option of increasing the tax base, or the type of transaction that the sale is applied to, particularly for the sales tax, or increasing the rate that the tax is applied at. The sales tax is the first revenue source large enough that increases in revenue could offset a decline in the sales tax. One method to do so is to increase the sales tax rate. Article 9, Section 8 of Michigan's Constitution states that the legislature shall not impose a sales tax on retailers at a rate of more than 4% of their gross taxable sales of tangible personal property. While this rate was supplemented with Proposal A in 1994, adding a 2% sales and use tax increase for school operations, further increases would need to be implemented through a constitutional amendment. This barrier makes it unlikely that an increase in sales and use tax rates can fill in for an income tax decline. A second option would be to expand the sales tax base. Over the last 2 decades, the importance of services in the state's economy has increased significantly, but the tax system has lagged behind following that reality. According to the Bureau of Economic Analysis, in 1977, services accounted for 11% of gross state product, rose to 20% by the turn of the century, and in 2015, that number has more than doubled. While services have quickly become a significant part of individual consumption in Michigan, the tax code has not changed to reflect these developments. Michigan is in the bottom quarter of all states for the number of taxes levied on services. Because of this disparity, expanding the sales tax to include services could fill in the revenue lost from an income tax. The Michigan Department of Treasury estimates that taxing services such as physician visits, entertainment admissions, hair care, and repair services could generate as much as $12 billion in tax revenues, though some services would likely be excluded from a tax, reducing that figure. While amending the sales tax could provide the level of revenue to offset the decline in the sales tax, there are potential roadblocks that show it is not a perfect solution. First, as the sales tax is heavily earmarked, many changes to state law, including changes to the Constitution, would have to be made. Additionally, attempts to tax services have been a political challenge. In 2007, the legislature attempted to establish a service tax, but failed to come to an agreement on what services should be excluded. This caused very heated discussions and proved to be a very sensitive issue for many constituents and legislators. There are other economic considerations as well. Adding services to the sales tax base would increase the horizontal equity of the system, the principle that individuals with the same spending patterns and income should be taxed similarly. Under the current system, individuals who consume more services, such as event attendance or admissions, will pay less in taxes than someone who spends the same amount on physical goods. This privileges consumption of services over goods and creates an overall less equal system. However, sales taxes tend to be a more regressive form of taxation, reducing vertical equity in the system, or the principle that lower-income people should not have to pay a larger share of their income in taxes than higher-income people. Because lower-income people have less ability to save, a larger share of their income goes towards goods and services. An expansion of the sales tax would increase the share of tax burden that lower-income families pay. While exemptions, like the state's exemption on food and prescription drugs, can make the system less regressive, they also reduce horizontal equity by taxing people more for spending less on exempted goods. So the net effect on equity from an expansion of the sales tax is uncertain. The second option, the property tax, is the other revenue source large enough to have the potential to offset declines in the income tax. Because any significant cut in the income tax would require billions of dollars in revenue, it is unlikely that increasing the tax base would raise significant, or this tax rate would raise significant enough revenue to offset such a decline. The state education tax is a good parameter for long-term trends, as the tax rate has remained stable at 6% since its enactment in 1995. As the SET demonstrates, property taxes are far from assured to grow over the long term. While revenue from the SET increased around 40% from 1995 to 2006, nearly all of the gains were lost as the foreclosure crisis and subsequent economic downturn suppressed values. For the state to increase revenues to offset an elimination of the income tax, the state would have to impose a tax rate of 30 mills, or 3% of the property's taxable value. When school, county, city, and other millages are included, some areas of the state would see levies in excess of 100 mills, or 10% of the taxable value. Beyond the high levels of taxes that would have to be levied to fund this offset, constitutional limitations reduce the potential effectiveness of property tax as an alternative. A property's taxable value begins at 50% of the value of the property. However, each year the taxable value increases, but those increases are capped at the lesser of 5% growth rate or inflation. A property generally only returns to the 50% taxable value upon sale when the transfer of ownership resets the taxable value. This is typically known as the pop-up effect. Because of these limitations, revenue from the property tax increases at a much slower rate than other potential revenue sources and would not increase proportionately to the way the income tax does. Trends show that it is unlikely that the property tax would grow at a rate sustained enough to support long-term revenue needed without a significant hike in the rate. Another potential issue with an increase in the property tax is the regressive nature of such a system. Because there is no direct relationship between income and the value of an individual's property, property taxes can put a larger share of the burden on lower income families. This can be especially true of younger homeowners who purchase based on future income potential, and elderly homeowners whose property value may no longer reflect their income. These effects would be magnified by the loss of the homestead tax credit for lower income individuals if the income tax were to be cut entirely, as they are a credit provided to an individual's income tax and would no longer exist. Thus, increasing the property tax could shift some tax burden onto poorer individuals. The final option that the state has to offset a decline in the income tax is to cut spending. State spending operates differently from most other local governments. Less than 20% of expenditures finance programs that the state operates, and only 11% of the total budget funds employee compensation, while for local governments these numbers are significantly higher. The remaining 80% of the budget goes towards schools and colleges, cities, villages, townships, and counties, and organizations providing state-funded services. To get a better understanding of what services are funded at the state level, the chart pictured shows the distribution of general purpose portion of the state general fund. The GFGP budget currently sits at about $10 billion. 32% goes to community health services and Medicaid, about 20% to the correction system, 14% to higher education, 10% to human services, and the remaining 25% go to state police, school aid, transportation costs, debt service, and other administrative costs. Multiple factors put pressure on the state that make it difficult to cut funding from the GFGP budget. First, some of the resources committed in the GFGP budget are used to bring in federal funding. Many grants work on a per dollar matching basis. This is particularly true of Medicare and Medicaid grants, which provide significant amounts of funding based on each dollar that the state will spend. In these areas, single dollar cuts to the state's revenue could result in multiple dollar cuts in spending. An additional pressure is a relative decline in the GFGP budget. Since fiscal year 2000, the GFGP budget has declined 30%. The combination of these two make cuts to an already lean budget potentially significant. Beyond problems that exist in the budget currently, there are a number of upcoming challenges that make the budget environment difficult. These include the state's mega tax credits, which will reduce revenue by an average of $700 million over the next 2 years and will continue until about 2031. The highway funding bill, which will phase in until costs about $600 million a year, reaching that peak in 2021. The homestead and earned income tax credits, which will reduce revenues by over $200 million a year, though these would not be a concern if the income tax were eliminated, as they would be removed entirely. The personal property tax reimbursement, an effort to repay local revenues lost from the personal property tax relief effort, which will cost more than $500 million when fully implemented. The Healthy Michigan Plan, as the state has to pay its contribution to the federal Medicaid expansion, which will cost the state $160 million this year and escalate as the state contribution grows, and other declines in revenue, such as the removal of the tax on the difference provision, the removal of the use tax on Medicaid managed care, and the state's Indigent Defense Commission Act. With future revenue reductions and the expenditure increases to the tune of more than $2 billion a year, reducing state spending to offset a removal of the state income tax would force significant reductions across the board. As 72% of the GFGP revenue is raised through the income tax, without factoring in impending pressures, the legislature would have to cut about $7 billion from the general fund if it were to completely remove the income tax. Because of the factors discussed, even a decline in the income tax rate will require the state to make extremely consequential decisions. An elimination would likely put extreme pressures on the state budget or would require a complete overhaul of the state's current revenue system. And with that, I'll send it back to Tim.
Thank you, Jordan, and thank you, Eric. That concludes today's presentation. It doesn't appear that we have any questions, so we'll end by saying that if you do have follow-up questions about today's material, please send those to us via email. And finally, just a reminder that you'll receive an email soliciting feedback on today's webinar. We look forward to hearing any comments or questions you may have. Thank you.